Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me live on set at MarketSite is Steve Gattuso, who's a Senior Portfolio Manager and Director of Investment Strategy over at Courier Capital. And we're going to focus on rising interest rates. Steve, it's great to have you back at MarketSite with me. Let's talk about the interest rate impact on the consumer. Is this going to trickle down to us in any way?
Most definitely. In fact, most are probably feeling it right now because from a consumer perspective, anything that is set up as a floating rate instrument, your credit cards, your home equity lines of credit, even if they still exist, some adjustable rate mortgages, the reset, if it hasn't already happened, is going to happen very quickly. So you're going to see it that way. But even a larger impact is going to be in the mortgage market. Currently, right now, we look into Case-Shiller, home prices have been on a tear. They're up another 6.8%. This past year. You've got markets like San Francisco, Las Vegas, Seattle that are up double digits. So you already have the challenge of increasing home prices, but now you're adding in an additional cost of financing. So a few months ago, average 30-year conventional mortgage was at 4%. Now they're about 4.5%. That adds 6% to the monthly price of your mortgage.
Right.
So it's making home affordability even more challenging.
So what will that do to the housing market? Will it become stagnant or?
It's a very good question because right now there's already the price impact of low supply, low inventory. So that's going to make it even more difficult for especially new entry home buyers to try and get into the market. But yes, I think the potential exists as those mortgage rates rise for the entire market to start to cool off a little bit.
Now, how do rising interest rates impact government finances?
That's even more critical, and that one's behind the scenes a little bit because if we're looking at these rising rates, there's a couple of things happening right now. We have increasing deficits each year. Right now, as of this last month, current deficit is $530 billion. We're on track for an $800 billion deficit. Projections by CBO are another $1 trillion by 2020 and increasing from there. We're going to hit 5% of GDP by 2022 possibly. So we have the credit card that we keep increasing by adding the increasing deficits. The debt level already at 21 trillion, 15.5 of it being public debt, another 5.5 being intragovernmental, but the interest costs on that so far this year, they're up 15%, another $32 billion in interest costs this year. The average financing rate of government debt was 2.27, it's now 2.42, and we're to the point right now where each 0.25% rise, and I'm using that because that's typically what the Fed has been doing lately, results in another $50 billion of interest service cost on federal debt, and that's on a flat 21 trillion. As we add to that amount in terms of the debt, it's going to increase even more.
Well, we've heard that rising interest rates, particularly coming out of the financial crisis over the past 10 years, that's a sign that the economy is doing good. That's what we've been told. So are there any beneficiaries with rising interest rates?
There are beneficiaries. For the last 10 years or so, lenders, or people who are borrowing, I should say, have been at an advantage at the cost of savers. So that is starting to turn around a little bit right now because if you take your typical retiree or people who just have excess savings, there really was nowhere to go except to risky assets. And they've been subsidizing the people who are borrowing money. And that is just starting to turn around a little bit right now. So those retirees right now that depend on interest income, for example, are starting to see a little bit of a bounce in that interest income coming in. Them and the same goes for pension plans, because pension plans have a good portion of their assets in fixed income instruments, and for them, they have a high rate of return they're expecting in order to meet their pension obligations. They're starting to see a little bit of that benefit as well.
All right, well, thank you very much, Steve, for joining us at MarketSite. And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.